Welcome to the Retire Right podcast with Larry Heller. You deserve complete financial advice. There's no acceptable alternative if you want a plan to live well and on your terms. Complete financial advice equals complete peace of mind. Now, let's get into this week's podcast episode.
Hello and welcome to Retire Right with Larry Heller from Heller Wealth Management. Larry, I hear we're talking about cash today. I like cash.
Yes, actually cash and retirement. So
Cash
a combination of
and
both.
retirement. We're talking about the green stuff, not the Johnny cash, right?
Correct. The
Got
green stuff.
The green stuff. All right. So cash in retirement or cash approaching retirement, what are we tackling today?
Well, kind of really the same thing as you get within 3 years of retirement and then throughout retirement. How much cash do you really need? And with cash interest rates virtually zero these days, and they have been for a long time, it's a very interesting discussion on what you should do because you're not earning any money on your cash. So what is the right answer? And I always tell people there's really two factors to look at. One is the kind of financial decision factor, and the other one is the sleep factor. All the planning that we do, we kind of talk about both of that, whether it's cash or whether should I have a mortgage, what's the right answer, and what is the answer that works for you. Everyone's a little bit different.
I like the way you put that sleep factor, right? I mean, that's worry and concern. That keeps people up all the time for different reasons in their life. And I know finances are one of the main things that, drive a wedge in marriages, and, people have sleepless nights. So I'm hoping that you'll give us a clue here. I know that each individual is different, but what's a good rule of thumb?
Right. No, we're going to definitely dive into that. And it's not only the sleep factor, but it's also having the right amount in cash so you stick to your financial plan. Because if you don't stick to your financial plan, that's when problems come up. And we'll talk a little bit more about that. So interesting enough, this week, or probably by the time the podcast comes out, it'll be a few weeks old, but CNBC, they actually quoted me in an article, and you can go into cnbc.com and go into their investment section, and then under their personal finance section, and just scroll down. It was August 16th was the date, and a lot of different advisors had a lot of different opinions on how much cash you should keep in your portfolio. And some advisors, cash is not making you any money, so you really shouldn't have any cash in that. And I'm definitely from a different point of view, in that you should have cash in there again, so you can stick to your game plan when there's a market correction. And I'll go through a couple examples in a few minutes. It also allows you to maintain your equity allocation. So I look at cash from the first standpoint is really from an expenses, like how much cash do you need really has a factor on how much are you pulling out of your portfolio, how much do you need to spend on your lifestyle. So the first thing really is determining what your expenses are. I still can't believe how many people I talk to as they're approaching retirement, and I'm asking them, well, how much money do you need in retirement? And they're like, I think this much, but I'm not really sure. And I'm like, if you miss by a big number, it's going to have a dramatic effect on your whole retirement planning. So the first thing that we do is figure out, okay, what is your monthly expenses? What is your yearly expenses? How much are you going to need? So that's really step one that you should do. And then step two is really, what is your proper asset allocation? I think we've talked about that on some different podcasts. How much equity should you have in your portfolio? How much fixed income? And we use a questionnaire. We've been using this for probably 20 years, a Finametrica questionnaire. They were recently bought out by a firm, and then that firm was bought out by Morningstar. And it's a 25 question questionnaire, not some of these 4 or 5 questionnaires that try to figure out what your risks are. So we use that first really get an idea, again, what are you comfortable with and how much are you comfortable in the stock market and equities. And what we found is this risk tolerance gives us a good idea about what you're comfortable with and what you'll stay the course during your life in the amount of equities that you have. So once we determine what your allocation is, and I'm just going to use an example. Let's say the allocation and we talk about is 50-50, 50% in equities, 50% in bonds. And we've then actually looked at some of these studies, again, that were done by Phonometrica. And Phonometrica has done a study using a diversified asset allocation portfolio from January 1st, 1972 to December 31st, 2020. They update it every year. So we're now 48 years of data. And they actually show, there's a lot of things in the study, but it shows the top 10 highest returns over a short period of time, and it shows the top 10 worst returns over the short period of time. Just as a side, anyone who's interested about this study, want to contact me, I'll gladly share that with them. But once we focus now on the worst, the 10 worst scenarios, and kind of look at this from the, not only from the high, but how long it recovered. So I'm going to give you a couple examples. So one of the worst ones, the biggest drop was, remember, the bank collapse in October 2007. So the fall was on a 50-50 portfolio. A full equity portfolio fell a lot more, but a 50-50 portfolio fell 32%. And it happened over 16 months. And then it took another 21 months to recover from the low. So from October 2007, almost a little over 3 years later, you recouped your money. November 2010. It took 3 years to recoup your money from a 50-50 portfolio. People kind of maybe forgot about that. We had a little bit of a hint about that in the beginning of 2020, but the downturn was about 12%, and it fell in 2 months, but it recovered in 3 months. But the other two top times that your portfolio would have fallen over 20% was August 2000, the tech correction, which I do remember. Again, it was 2 years from the high to the low and another 16 months to recover. So August 2000 to January 2004. And we all probably don't remember, but July 1973 was a 22% downturn, and it took 27 months from the beginning to the end. So why do I talk about that? So one of the things is, I don't care how much money you have. When we go through these big, quick downturns, people get nervous. And they start to thinking, oh, I've got to stop the bleeding. I've got to sell. I don't want it to go down anymore. It's going to go to zero. Just the opposite what everybody should do. But that's just psychological. People panic when it's down, and then when things are going great and really high, they want to buy more. And you want to do just the opposite. You want to sell high and buy low. So how do you stay the course? How do you do not panic when the market is down? And better yet, how do you rebalance and add to the equities when it's down? One of the ways to do that is if you have enough cash to ride out the downturn. So I just discussed three of the top falls for a 50-50 portfolio. So if you're in that allocation, the worst time frame was 39 months. So what we're kind of looking at is cash somewhere in the 24 to 39 months right now, especially now with the bull market and a long run on there, or a little bit higher on our cash allocation. So, and if you have a higher equity exposure, a 60% or an 80% exposure to allocation, you should have a little bit more cash in, because the time to recover is going to be longer. Now, we use something what's called a cash reservoir, or actually our reservoir strategy, which includes cash. So part of the way we set this up is you have a long-term reservoir and a medium-term reservoir, and that kind of flows into your short-term reservoir. And that's where your cash is. That's where the 24 to 39 months that we're saying that you should have in there. And then that money is then sent to you or taken out of your portfolio to spend on. Now, some of the investments in your medium term and your long term may be throwing off dividends. So the dividends in cash go into your portfolio. So that's why we have the range. Some people have enough dividends that they're getting almost 1 year's worth of cash from the dividends. So we can be on the lower end of our 24 to 39 months. So there's always a range in there, and what people are comfortable in there, and this allows you to stay the course. And that goes back to our sleep factor. I can tell you that this worked in 2000 and 2008, where we did a lot of handholding to say, hey, we have enough cash to ride this out in our short term. And worst case scenario, even if it didn't recover in 3 years, we still have money in your fixed income, your medium term portfolio. As long as you believe that somewhere down the road, 10 years down the road, your equities are going to come back and outperform, don't panic now and sell now. And by the time 2020 came about, our clients that have gone through it in 2008, they didn't even need to hear the story. In fact, they were like, well, how much are we rebalanced? How much are we putting back into the market? So for those that have gone through a downturn in retirement, they've seen it once, maybe they're a little bit more inclined to be a little bit more confident. But for those that have never seen that, I guess a little bit in 2020, but for those that haven't retired after 2008 and we've gone through this bull market, it's going to happen again. I can't tell you when, I can't tell you how much, but we will have another one of these time frames, and having enough cash in your portfolio allows you to sleep right. And if you do it, if you're creating the portfolio right, the 50-50 portfolio should throw off enough of returns to you that you can maintain your lifestyle in retirement. So it's a combination of everything.
Okay, I want to go back to something you said, Larry, because I don't want to gloss over it by any means. You're talking about living expenses, 24 to 39 months. But at the same time, you also mentioned being able to purchase when the market is low. So when we do have a major downturn, are you suggesting that people put away living expenses, that 24 to 39 months, and then maybe some additional monies that they can use to get, put more into the market when it's on sale?
No. So what we're saying is, remember that medium-term reservoir that's in your fixed income? We would use some of that to purchase equities. So we're still going to maintain the cash allocation. We just now may rebound. So now if your 50-50 portfolio is now 40-60, we would take some of the fixed income to go back to 50-50. So we're buying some equities on the long term, but we're still maintaining our cash position. Now, if we did have a big market correction, we may not be adding to cash, we may let the cash go down because there's no reason to sell some other investments to replenish the cash after we've had one of these downturns.
Okay. Thanks for clearing that up. I've always kind of wondered how you can buy stuff on sale if you're waiting out that downturn, but that makes sense.
Yeah, I've had plenty of conversations with very smart people who have always said, well, I have a lot in cash because I'm waiting for that correction. We've talked about this before. I can't tell you how many people that I spoke to, not clients, but other people, astute people who thought the market was going to go way down from the election, so they kept a lot of money in cash. And guess what? That November was one of the best Novembers in the history of the stock market. So they're never going to make that up. So trying to figure that out by keeping cash in place because you think you're going to have that opportunity yes, maybe you get lucky and you get it right one time, but more than often we've seen that you miss out the opportunity.
Yeah.
And then the worst thing is to see people who have sold after a correction and then don't get back in because they're waiting for the right opportunity. So trying to time the market and figure that out. I've been doing this so long, so many times. You really just can't figure it out. And all the people that say that they can and you should move out of cash, some people are going to get it right because if there's enough people out there making predictions, some are going to get their right predictions, but you're never going to be able to consistently do that.
Yep. Timing it twice, it's a bad idea.
Yes, and there's a big difference. You're still in your working years, Eric, but once that spigot is turned off and there's no more money coming in, maybe you have Social Security, but no more money coming in, it's a whole different mindset, a whole different feeling when you're seeing that portfolio go down on paper. While you're working now, you're like, I got plenty of time to wait for it to come back up. I'm still earning a living. I'm still putting money away. No big deal. But when you're in retirement, from all of our retired clients that we talk to, it's a much different mindset.
Yeah. Absolutely. All right. For those that are listening that are not working with somebody already who's telling them this information, obviously I'm going to tell them to reach out to you. So what could they do to reach out to you and what kind of conversation are you going to have with them?
Yeah, sure. So thanks, Eric. You can just go to our website, hellerwealthmanagement.com, and on the homepage, click down and schedule a 20-minute no-cost consultation to see if we can help you out and if you're a fit for us. Or just feel free to call the office, 631-293-2806.
Larry, thank you so much for putting out that information. I'm hoping that the listener that is hearing this podcast is going, wait a second, maybe I don't have that much set aside, or maybe I need more, maybe I have too much set aside and I need less. I hope they call you. I hope they reach out through the website and make that appointment for that 20 minutes. That would be great because it can definitely impact the rest of their retirement. Again, Larry, thank you so much for the info today. And of course, our last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Retire Right podcast with Larry Heller. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Larry comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you for listening today. For everyone at Heller Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.